where's the market headed from here on, and what sort of a portfolio should one have at this point in time? We're joined by Trideep Bhattacharya, who is the CIO Equities at Edelweiss Mutual Funds, joining us on the show right now. A very good afternoon to you, Mr. Bhattacharya. Thank you so much for joining us in ET Now. And first question being the way how the market is shaped out at this point in time, we've seen some sort of a moderation come in, at least for the benchmark indices. Where do you see, or which are the pockets where you see value lying right now?
Good afternoon. Thanks for inviting me to your show. And yes, I think overall, I would say that when we look at markets at current levels, while the markets have been digesting various different news, starting with elections, then the budget, then the reality of rate cut in United States, or not reality, but the expectation of rate cut in United States. I think we are now gradually looking at a second half, which we have the event that we need to grapple with is basically US elections and what comes along with it. And mind you, that is no mean ask for the market, because if you look at elections around the globe in this year, there has been meaningful digression versus what the consensus expectation was going into elections, and was it what it turned out to be in the form of the government, the way it came in power. In India also, while the policy continuity was there, but the mandate was a little fragile than what it is. Now, in this context, where do we see value? I would argue that over the last 3 to 6 months, the sectors that we have added our more weightage towards in our portfolio has been IT services and consumption. And when I'm saying IT services, I also include the platform companies that sort of fall under broadly the IT services or IT bucket. And when I'm talking consumption, I'm including not only the traditional consumer staples or FMCG, but also consumer discretionary, a few bits along with that. I think between Modi 2.0 and Modi 3.0, the importance of consumption will probably inch up a little bit, keeping in mind that there might be some populist measures that have come and might come going forward. In the context of IT, I think as we move towards basically a rate cut kind of a scenario in the United States, some part of IT would actually stand to see benefit from the same, and because it's a global facing industry, and we've sort of we have added to that. It might first happen in sentiment and in numbers later on, but that's another area that we think we should benefit from the same. And the third area that I would point to is the rate sensitive financials, in the sense non-banking financial companies which ultimately benefit from rate cuts globally are another area that we have added on to. So these are the three areas where we have added to. In terms of areas that we have taken profits from to fund these, they would be the thematically popular areas, if I may call it that way, like defense, capital goods are the two such areas that I would point to. We think that the sector leadership will continue to be capital goods, and defense will continue to have a solid future going forward. But I think given a plethora of thematic funds that have happened over the last 3-6 months in equity markets, valuations near term look a little on the higher side, which is why we have taken some profits. So a long-winded answer to your question, but I hope it sets the context.
Definitely sets the context. In fact, I wanted to come to the defense space, especially the PSU space, and that's where defense theme. We've seen some sort of a profit booking coming in for those counters, and you've also actually alluded to that fact. But do you see that sort of a rise for the rest of the PSU pack, be it the railway segment or the PSU bank index, actually going on or rather continuing after taking a pause, or do you think that now for a while they are out of favor?
So the way I would answer the PSU question is like this, that overall, if you look at the last decade, PSU banks were, PSU not just banks, but PSUs in general were at a steep valuation discount to the private counterparts. Over the last 2 to 3 years, basically as the health of the PSUs, courtesy the regulatory framework, and also the numbers that have come out from PSUs have improved, this valuation discount has now narrowed. And at this point in time, I would say with regards to PSUs, the low-hanging fruits are already nullified. In the sense, the valuation discount has narrowed. From here on, PSUs will have to take a more nuanced view in the form of what the PSU does, what is the competitive advantage, and can they sort of withstand competition from private sector over a period of time. So we have taken some profits out of PSUs as well, particularly from the second rung PSUs whose competitive positioning is weak, and added and remain in those areas where competitive positioning is strong. Like, for instance, some companies in defense, for instance, some of the leading banks overall. But from the second run financials, where just because it's a PSU, their stocks have re-rated, we have taken some profits.
Right. What's your take coming in on the auto sector? Do you just speak about the consumer discretionary space? But I want to talk particularly about the auto sector. What's your view coming in on the auto space, especially the four-wheeler majors? Because of the last few months, we've seen the sales actually moderating for the auto space. There are concerns coming in on the inventory build-up as well. So what's your take coming in on the auto space, especially the four-wheeler majors? Talk about two-wheelers in a short while then.
So we are underweight four-wheelers overall in terms of exposure. We used to be overweight about 6 months ago, but we have taken our weightage down because some of the supernormal growth times coming out of COVID is kind of behind us. And going forward, it's not that there is anything structurally negative in there, but I think the growth rates would normalize probably in the next couple of years in the four-wheeler segment. Where we are relatively positioned are two types of companies. One is basically two-wheelers, and second is companies exposed to the rural theme, even with regards to four-wheelers. Companies exposed to rural economy and two-wheelers are two areas that we are positive on in the context of autos.
Right. And what about four-wheeler majors? I believe that you have some exposure to some of the two-wheeler majors, I beg your pardon. And you also have now competition coming in, especially when you talk about the EV space. Now, you have a new entrant also into the stock market when you talk about the EV space of an automaker which is purely based on EV. What's your take coming in on the two-wheeler space then?
Two-wheelers we are positive on. We are betting on traditional business models who have the brand, have the distribution, and who are foraying into EV to a certain extent. But have a traditional business to go along with. My sense is that the pendulum with regards to EV has probably swung or had swung a bit too positive, and now with alternatives like hybrids, smart hybrids, etc. coming in, it is probably kind of swinging back to a more normalized scenario. We expect this to happen over the next 3 to 6 months, where valuations of EV-focused companies, pure EV-focused companies, get more reasonable. And as they get more reasonable, we might take a more lenient view towards that. But at the moment, we have taken a more conservative view with regards to pure EVs and focused on those traditional business models which also have EV exposure, because it's kind of best of both the worlds. If EV sales slows like it's happening globally, then the traditional traditional offerings pick up space, and at the same time that gives the traditional business model company a bit of time to adjust its business model towards the reality, which is moving towards eco-friendly alternatives.
Mr. Bhattacharya, but last but not the least, there's one sector that everyone's actually looking at with renewed vigor, and that has to be the new age tech sector, right? Because given the fact that they all have made a comeback, a solid comeback for some of them, what's your take on that? Are you looking at that space? Do you think that it has reached its fair value, or do you think it's still in a void?
So the new age tech as a terminology needs to be kind of defined more clearly, and I would say platform-based companies. Platform-based companies is something that we have really taken a positive view on, as long as they make cash flows. Sometime
recording stopped.
A few years ago, when these got listed, but at the same time they were not making profits. therein we were not present in those. But since the time they've started talking profits and cash flows, we have increased our exposure to platform-based companies in travel, in financials, and various different companies, in various different sectors. And we think that that's the way to go. That's the new age business model within tech, and it's here to stay. So our exposure to new age companies, put this way, which is platform-based companies, would be anywhere between 6 to 10% of the portfolio, and we think it's on the way up.
This company is the way to go, as you would term the new age tech space. But thank you so much, Mr. Bhattacharya, for joining us on the show, giving us your view on various sectors, especially the space that you like and you see prospects going ahead. Thank you once again for being part of ET Now.
If you like this video, then like, share and subscribe to ET Now.